What's up, everybody? Dave, the military millionaire, here today, and I want to talk to you about the cash flow quadrant, which was created by Robert Kiyosaki. I think it's a very valuable thing. However, this is kind of interesting. This is one of the first articles I've ever had written by a freelancer that I've actually tried to turn into a video. So we're going to see how this goes. However, he did a good job writing this article, and I just wanted to break this down, which is the ESBI quadrants, the employee, self-employed, business owner, and investor quadrants of the cash flow quadrant. And knowing this will absolutely help you build wealth. This is very valuable, so definitely pay attention and check this out. So as I stated, Robert Kiyosaki, the author of Rich Dad Poor Dad, also wrote the book Cash Flow Quadrant to describe various ways in which people make income. Now we're going to look at how income is generated in each of the 4 quadrants in this video. And yes, we all can make money from a single quadrant or even multiple quadrants, right? So you can choose to make money from a combination of quadrants, and the goal is kind of to move your way over to the B and I side, as I'll explain. But here's how we're going to run through it, right? So we're going to discuss each quadrant individually. So they're the E, S, B, and I, which stand for employee, self-employed, business owner, and investor. Now, the left quadrant, as you're looking at it, so the E and S, those are income generation quadrants, right? So the left side holds quadrants, employment, or employed and self-employed. Now, your earnings are going to be classified as earned income or active income in this case, and you're going to be paid for the number of hours you work in the quadrants on the left side. The playing field for the poor and middle class is on these 2 left quadrants, right? This is the more taxed income side. This is where people stay. The right side of the quadrant, which is the B and I side, the business and investor side, these are on the right side of the quadrant, and they are where their wealth is regarded as more passive. So this means you can make more money by using the efforts of others and leveraging and scaling. Playing field for the rich and financially secure is the right 2 quadrants, business and investors. Right now, capital, education, and a new mentality are required to move from the left side to the right side. Now, as you look at the chart again, from the top quadrants, the top 2 they have your income coming from only one source, employee, or your job, or a business. Because income diversity is minimal in the top quadrants, you face higher business and market volatility. Your income stops if your company that you work for goes bankrupt, or if your business goes bankrupt, right? So if you're a business, if you're in the business owner quadrant and you lay out your business carefully, you'll have different clients from various business sectors, reducing the risk. But still, if business goes out, business goes out. Now, the bottom 2 quadrants are when they're correctly designed, your earnings are going to come from a variety of sources, right? So as a result, a single customer, or if a single customer fails on this side or investment fails on this side, you're going to have a diverse revenue source from which you will not lose all your earnings. So now to dig into the quadrant specifically. First is the E Quadrant Employee. So the cash flow quadrant. If you work as an employee, you know that you're going to get paid as long as you keep working for the company, even though it's not very profitable. However, when it comes time to paying off debt, such as home or car loans, having to clear a monthly wage is, it's critical, right? Having a clear monthly wage. On the other hand, full-time workers derive their income from a single source, their work. And if they lose their job, they lose their entire salary. They must rely on this income and rely on unemployment to fill any gaps in jobs if something happens. Now, furthermore, workers pay the highest percentage of their income as income taxes. So as you earn more as an employee, your tax bracket rises and you have few options for lowering your income via deductions or credits. Now, this quadrant is where a majority of Americans make their money. The next one is the self-employed, or the S quadrant. So this is the next cash flow quadrant, and you own a job where you work for yourself, or self-employed, right? So this is not an employer corporation. So like a self-employed, non-owner corporations like this, in which the owner is the sole employee, often referred to as like a sole proprietorship. When you work for yourself, you trade one boss for many bosses or clients. So you have the freedom to work whatever hours you want, but you only get paid when you're on contract. The more hours you work, the more money you make. Self-employed people do not get paid weekends or holidays or when they don't work, right? So this would be like owning a plumbing company or a maintenance company where you're the person running everything. And so as long as you're working, you get paid, you might get paid well, but you're not leveraging other people. You're doing the work yourself. So some self-employed people can earn money from many different contracts simultaneously, which allows them to diversify their income a little bit. But on the other hand, many self-employed individuals merely work for a previous employer or a single customer as a contractor, and they don't diversify their income very much. Now, the truth is that many self-employed people have taken on more financial risk by working for themselves with little or no extra compensation. One of the reasons for this is that when we talk about taxes, the self-employed person must pay both the employer and employee portions of FICA, also known as self-employment or SE tax, on all taxable income. So many costs of doing business include cell phones, travel, whatever, can be paid with pre-tax dollars, which does allow self-employed people to decrease their taxable income, but they're still getting hit with both sides of that income tax. So smart self-employed people price their offerings to meet all their indirect costs, such as the extra and FICA share paid by the employer and any downtime between projects. The next quadrant is the B quadrant, the business owner cash flow quadrant. Being an owner of the business is far from being self-employed. Now you're hiring people to do your job for you, and that's not to say that the business employer doesn't work in the company, but it does mean that they are compensated for both their job as an employee and their investment in the company. So this is where, like, if you were that plumber and then you started to scale to where you're overseeing a whole bunch of other plumbers, so your job has changed, but you also make a portion of that money, right? Now, business owners can expand their operations, which is not possible for self-employed people. As the company grows, a portion of each employee, their bill rate represents the owner's return on investment for the initial money and taking on the extra risk of becoming a business owner. As the company expands, the owner gains more and more money. As with being self-employed, you have many bosses and your clients form, right? So you are the boss of your employees, but you still have clients to deal with, right? So business owners have systems that allow them to be away from the business for extended periods of time. Now, business owners' income diversification and taxes are similar to those of self-employed people. However, unlike the self-employed, if the company is a S Corp or C Corporation, not all revenue is subject to the combined 15.3% FICA contribution. So wages from working in the industry are subject to FICA for companies, but FICA does not apply to the profit that remains after all costs and wages have been paid. All right, so taxation on a business is going to work a little bit differently than taxation on just a self-employed person, and you're able to leverage and scale all of your employees. Now, the investor is the fourth cash flow quadrant, right? And this is all about investing your money to work for you. This is the real estate investing, the stock market, and everything else. Now, as an investor, you should spread your money around to achieve greater income diversification while reducing overall risk by concentrating your investments less, right? So you want to be a little bit diversified. When it comes to taxation, there is a logical progression. Interest income from derived from sources such as money, markets, bonds, bills is one of the investment spectrums. Ordinary dividends, such as those paid to company owners, and short-term capital gains are also on this end of the spectrum. There are no special tax benefits for any of these investments. Now, qualified dividends and long-term capital gains, on the other hand, on the opposite side of the spectrum, they have benefit from special tax treatment, and you progress along the continuum. These financial products are taxed at a fixed 15% rate for most investors, rather than being taxed based on how much money you make. So this is like the difference between like short-term like day trading stocks and like long-term real estate investing with depreciation and stuff, right? So the ultra wealthy pay 20%, which is far less tax than the marginal income rate for most investors. Municipal bonds, for example, which are the federal income tax-free interest income, are the next step on the continuum. Aside from that, there's real estate income, which can be depreciated to reduce taxable income as well. So additional capital gains usually are taxed when a property is sold, and then you can defer them with a 1031 exchange, which allows investors to increase their assets without having to pay capital gains tax per transaction. I'm about to use a 1031 to roll into a larger apartment. Ultimately, direct participation in oil and gas programs is also an option, but you just kind of need to understand the investing spectrum. There's a lot of ways that you can make money and still have lower taxes. You can deduct the majority of your investment from different revenue sources, such as employment. Furthermore, thanks to a depletion allowance, only 85% of revenue is taxed. Most investors, however, must be accredited to participate in this game, as it indicates that, and accreditation means that you have a net worth of $1 million or a yearly income over $250,000 or a little bit more if you're married. Now, how do you move from the left to the right quadrants? So I recommend that you're going to start changing your attitude, right? If you want to move to the right side of the cash flow quadrant, a study was conducted a while back that revealed the mentality of some of those who went from poverty to riches. And 3 factors were identified as deciding factors. Those are that they had a long-term vision, delayed gratification was crucial, and they learned to use the power of compounding. Now, they also looked at those who had been rich but had fallen back into poverty. And the following 3 factors played a role. Now, the path to the right side of the quadrant begins with the acquisition of assets that generate passive income, rather than living paycheck to paycheck. Begin small, be patient, and watch your income grow over time. This could be dividend stocks, this could be real estate investing. This is what I did to help scale my way into financial freedom. The bottom line is this: if you wish to achieve financial freedom, you should spend time learning the ins and outs of the cash flow quadrant and begin shifting your income and investing strategies in order to move yourself further into the business and investor quadrants. The more of your income comes from business and investor quadrants. So you're getting this paycheck, start putting some of it into investments, right? And then eventually maybe you move to self-employed. You're still putting money into the investor side. And then maybe you eventually grow that into a business and you're pumping that. Like very wealthy people that I know, they do is they have a business that generates money that they pour into their investments. And then eventually their investments make enough money that they can retire, or that they can hire somebody to run the business while they retire, and the business still makes some money and they still buy investments, right? So it's all one big game. It's a lot of fun. Anyway, I hope this video helped you out. Cash flow quadrant is an important mindset shift. I definitely recommend that you check out the book, subscribe, click that notification bell, and of course, hit the like button, comment down below, give me some engagement if you like this video.